All right, all right. Good morning, good morning. Good, beautiful morning. The day is brighter every day. It's Wednesday. You know why it's a good day. Because we're going to talk about stocks. That's why it's a good day. It's a good day. All right, we're going to talk about the stock market today, and we're going to talk about ROCC. ROCC. What is ROCC? Now, that was what the little marquee out front of the little thumbnail on the YouTube channel said. We're going to talk about passive investing and ROCC. I think it's most important thing that we can learn about when we're talking about passive investing is ROCC. Okay, what is ROCC? ROCC. We're going to talk about that in just 1 minute. Teaser. It's called a teaser. All right. We're going to tease you into that. Just 1 second. Hang on. We're going to talk to you, but we're going to go look at our portfolio for just a minute and see what we got going here. And then we're going to talk about ROCC because it relates to our portfolio. So we have to talk about what that means after we look at our portfolio. All right. But we have to look at our portfolio first. So let's come over and take a little bit of a walkthrough of the things that we did last week. First of all, let's go look at Apple. Now, Apple, we sold a put right here. We thought Apple might turn around and go back up, apparently, and it didn't do that. So we received $530, and it's down $962. We're still going to receive our $530, but it shows that we're down $960. That's only if we liquidate it. That's only if we liquidate it. All right, Apple. You guys know my feelings about Apple. It's a rotten company. Not really. Not a rotten company. It's just not doing very good. It's not doing very well. Speak proper English. Not my favorite company for investing in. I like their products. I got their iPhone. What else do they have? They have their little Macintosh computers. Some people like those. I met somebody once that liked Macintosh. But nonetheless, they're kind of a one-trick pony at this point. The really thing that makes them all their money is their little iPhones. And, people are getting bored of buying new iPhones every year. They don't come out with nothing new. I mean, they're the exact same damn thing every single time they come out. Oh, the camera's a little nicer, and we rounded the corners of the edges. Come buy another $1,000 iPhone. Right? I mean, what's the difference between this one and the last 3, 4, 5, 6, 9 generations? Nothing. The best iPhone I ever had was the iPhone 4. That's the one I like the best. I wish I could go back to the iPhone 4. It was small. You could carry it in your pocket. You didn't really know it was there. It was skinny. It worked great. It was a perfect little iPhone. Now they're all like these, you're walking around with a damn tablet in your pocket. It's like, why don't I just have an iPad? Same thing. What's the difference? Oh, this one makes a cell phone call. That one doesn't. They're the same thing. They're like this much difference in size, and you have to carry it in your pocket. Anyway, my pet peeve and beef with Apple is their products are, I don't know, ever since that guy that was in charge left, quit, started his own business, Apple's kind of been like suffering a little bit. They haven't got any creativity left in their company. I don't know. This is just me. What do you guys think about Apple? We're not going to go over and look at the fundamentals because I did that last time, and they're not very good. So it's coming down and it's flushing, and we sold a put. So it means we're going to get along. We'll probably get some shares right here. How long do we have until this thing expires? 30 days. We'll see. It might turn around and come back. We'll just leave it right there right now. I'm not going to worry about it. We could sell another one down here if we want to. We might see if it wants to come down one more day. Let's see. We could go into options, and we could sell a put right here. We need a lot more time than that. Let's go out. Let's see what the value is of the. This is the 9-day options. $10 on the spread. Volume and open interest is fine. We could sell a 9-day one right here. We could sell a call right there, just down underneath it. Collect, receive $1,000. That would help us dig out of that hole, wouldn't it? And that's only 9 days to get $1,000. Let's do that. All right, so we're going to come in here. And let's see if they're not going to let us mark. They might let us market into it, but let's see. We're going to go down, since we're going to buy it, 1050. Oh, no, we're not buying it. We're selling it. So we got to go to the 1040. 10.4, good buddy. There we go. All right, we just made another $1,000 on our Apple. That should dig us out of the hole here a little bit. We're down 932 on that one, but that's just paper. That's paper dragging. Not really worried about it. This just means we get some shares up here. We still get our $530. Now we sell this one, we'll get another $1,040 on that one, but we only have to wait 9 days to make $1,000. That's pretty good money. All right, so we're coming and do the same thing with Amazon. Now, Amazon, I think we were actually looking for Amazon to continue to flush, and so we sold one here, and then we bought. Did we buy? We bought a put here, and we sold a call here. So that's why this one's, if we come down to our positions and we go to chart only, that's why we're up 315 on one and down 1,000 on the other. We might want to just cut our losses on that one. That market's going to the moon. Do you think it's going to turn around and flush? I don't think it is. So let's just go ahead and take our 815 loss on this thing. Although, you know, this one's, yeah, let's just get out of it. Liquidate. So we're just going to get out of this thing. Actually, let's cancel that. And we'll just do it like this. Exit all options. Not all options. Exit chart option. Hit all. It'll take us out of everything in the whole portfolio. And it works too. Ask me how I know. I accidentally did it once. I accidentally did it once with real money. All right, here we go. So we took that one off the table. Get rid of that loser, but we're still into Apple. We'll hang on to that one. Going into it looks like a fourth drive pattern to me. So that's drive 1, drive 2, drive 3, and it's trying to make a drive 4 up in there, which is crazy. Crazy, crazy. This is our new Darvis box right here. Broke across here, drive 1. It only took 2 drives to get to the top of the Darvis box. So if you draw your Darvis box in here, boom, 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 just like that. Now we're in a new Darvis box. So if you start a new Darvis box, so that's a 3 drive pattern, drive 1, drive 2, drive 3. We didn't ever get the pull back. So this could be a new Darvis box, drive 1, drive 2, and we'll go to another drive 3. Don't know, man. This thing's going to the moon. Everybody's got such happiness going on in this country. They just want to spend, make money, be happy. Did you hear that guy from Japan? I can't remember his name. What was his name? I watched Trump yesterday in the Oval Office. He had Sam Altman in there from OpenAI. Can you believe the very first day in office, the very first thing he does, a full day, the first full day in office, who does he bring into the office? He brings in the guy from Japan who offered $100 billion investment in the U.S. He brings in another big titan from the Silicon Valley, and then he brings in Sam Altman. Sam Altman, do you guys know who Sam Altman is? He was the little skinny guy that kind of seemed like he was a little shy to be there, right? And he got up and he was the last one to speak. If you saw the thing, the little skinny guy. He's the one who's in charge of ChatGPT. He's the president of ChatGPT. So the very first guys Trump brings into the office on his full day back at work is the OpenAI president, is the the guy over artificial intelligence. Can you believe that? And because of that, he brought in the other 2 big investors. The one guy was just a big Silicon Valley guy, but the guy from Japan offered $100 billion. And if you remember, he made a big deal about, I offered $100 billion investment in the U.S. And right there on TV, I'm going to ask you for $200 billion, right? I'm going to ask you for $200 billion. And so that was a big deal. He laughed. That's funny. I don't know if I can do $200 billion. Yesterday, he came into the Oval Office and said, I'm bringing back with me $500 billion. He offered 100. Trump asked him to bring 2. He came back yesterday and brought $500 billion and said, I'm going to invest $500 billion into the infrastructure of OpenAI, basically, of ChatGPT, of artificial intelligence. $500 billion they're going to invest. And that was the first thing Trump did in his office, in office that day. Crazy, right? I mean, that's just crazy. So ChatGPT is a big deal. Big deal. And Sam Altman told him, he says, we couldn't be doing what we're doing if it wasn't for you, Mr. President. Biden was giving him all kinds of shit about OpenAI and about what they were doing and trying to put all these regulations on them and slow them down, shut them down. Oh, AI's bad, bad, bad. Shut them down. We're going to regulate this thing, free speech, all this kind of stuff. They just went crazy against OpenAI and against artificial intelligence. Now, maybe you're against artificial intelligence. I'm not. I think it's a great thing. I love it. It's just a tool. It's just making computers finally do what we expected them to do, 30 years ago when they came out? When you unboxed your first TRS-80 and you said, all right, turn it on. All right, ask it a question. Isn't it supposed to be smart? Finally, computers 30 years later can do that. You can now ask it a question and it's smart and it knows how to answer your question. We've been waiting for that for 30 years. It's finally doing what we expected to do, a computer to do 30 years ago. So I love AI. I think it's it's just a tool. And people are like, oh, it's going to take over the world. It has no creativity. It has no motivation. It has no intuitiveness. That's all human characteristics. It's just a tool. It's just a database of knowledge, and you ask it a question and it knows how to search the database of knowledge and come back with an answer. That's all it is. And so people are scared of it because of Hollywood. Hollywood scares us. They scare us on everything. Aliens are going to come and take the country, take the world over. Maybe they are, who knows? But, AI is going to come back from the future and kill us all, all kinds of, that's Hollywood. And so everybody's scared of this stuff. It's just a database that you can search. And that's all it really is. It's just a really good database search tool. So don't freak out about it's going to take our jobs. Well, there's a lot of things that are going to take your jobs. What's going to take your jobs is not AI. It's going to be somebody who knows how to use AI better than you. That's who's going to take your job. All right. So if I know how to use a computer for the last 30 years better than you, I probably can take your job because I can use a computer better than you can. So AI is just knowing how to use the computer a little bit better than the next guy. And so he can take your job because he can be more productive. He can do more, right? That's just the nature of the beast. That's the way we've always moved through price. And that's the way we've always moved through time, right? You can do something more efficiently than the next guy. You're going to get the job. Well, what else takes your job besides AI? Injury takes your job. What if you're a bricklayer and you break your arm? Well, you can't go back to work and lay bricks. It broke your arm. Well, it'll heal. Okay, well, it might heal and you can lay bricks again. Maybe it won't heal. Maybe maybe you're a dancer and you broke your leg. Who knows, right? There's all kinds of things that can take your job. One of the worst things that takes our job, worse than AI could ever be, is old age. Old age takes your job more than, guaranteed 100% of everybody who's on earth so far, old age takes your job. And so that's what this is all about, right? We're trying to make enough money, have an income source, have money that we can have so that we can make enough money that if old age takes our job, we can still live, enjoy our lives, and have enough money to live. Oh, I'm just going to wait for the government to take care of me. And that's what's going to happen with AI. AI is going to come in and take my job, so the government's going to give me money. Well, are you that kind of person, really, that just wants to live off the government? Oh, give me the dole. Just give me a handout. I don't want to work. I just want you to give me money. Just give me money, Mr. Government, and just be a government guy. Just live off the government's Social Security, which is their UBI, Universal Basic Income. Okay. How well have they done that? How well have they provided you with a Social Security safety net? You trust the government? Who trusts the government? Obviously, about 75% of the country doesn't trust the government, which is why Donald Trump became president, right? They want somebody to go in there and fix things because it's so badly broken. They got some guy that's like a bull in a china shop said, hey, well, I think we need the bull in the china shop to go in there and break a few glasses, right? And so he hired another bull in the china shop, Elon Musk, to go in there and figure out how to break a few glasses and put things back on track. But if you think for your UBI, when old age comes along and you're just going to live off the government and off your Social Security, well, you might be able to live like that, but it might be a little tough. It's not exactly a super duper income. It's not what Elon Musk calls the universal high income. And so I want to help you get a universal high income. And the way we're going to do that is through capitalism. Sorry, if you think that's a swear word, it's the way the world's, the best model of business that we've had since the United States become a country is capitalism. So capitalism just means that it's, you earn money and you live off the money that you earn. It's kind of a novel concept, right? So we want to come in and we want to model capitalism in the financial markets. That's what the stock market is. It's capitalism. That's what it is. Take the capital of companies and corporations and we bring it into a big pool of, location where we can all trade on it. We can all own it. We can all own part of America. And that's what publicly traded companies are. It's just capital from the American businesses. So that's why it's called capitalism. So we're going to come in and we're going to own some American businesses and we're going to share in that profit that those companies make. And if you're like, well, I don't want to share in profits that the companies in America make, okay, well, you can go into socialism, which is social security, right? Socialism versus capitalism. Where do you want to get your money from? You want to get your money from socialism, then you go get your social security. You want to get your money from capitalism, well, you go to the capital markets and you get your money from the capital markets. It's just two different means and methods of looking at at how you're going to live when old age comes and takes your money away, right? Or takes your job away. So one of the best ways is through capitalism, through the capital markets, in my opinion. I mean, maybe you like the socialism idea and you just want somebody to give you money. Just here, I just want to sit on the dole and send me money. Okay, do that. But for those of you who are interested in working the capital markets, I think you've come to a good place and I can help you make that happen. I'll show you how to do it. Okay, so that's what this is all about. And the best way to do it is to buy low, sell high. You ever heard that term? Buy low, sell high. And so you got to sell to take your profits. Now, this is going to go into ROCC, and this is going to lead you into what the conversation of the day is ROCC. What is ROCC? Well, we're going to get into that here in just a minute, but we got to talk about capitalism first and talk about the capital markets. And so the way you make money in the capital markets is you buy low and you sell high. And then you make the difference between what you bought it for down here and what you sold it for up there, right? Now, when do you sell? That's the name of the game, right? When do you sell? Well, I don't need the money today, so I'm not going to sell it today. I don't need it till I'm ready to retire. Okay, well, then you would hang on to your position for a long period of time. That's called buy and hold, right? Buy and hold. We're going to buy and hold it for a long time. Well, Lan, I'm already 60 years old. I'm already 65 years old. I need the money today. I don't have time to buy and hold. I missed that opportunity. So what am I going to do? Well, that's where ROCC comes into play. And we'll go talk about how you can do it if you're an old guy like me and want to have income as opposed to capital growth. Okay. So we want income versus capital growth. Now, what is better? Well, both are good. We like both. Capital growth is really good. That's awesome. That's why we're here playing capital growth right now, right? But we also like income. Now, I want to give you a little scenario, and I've mentioned this to some of you before, and you're familiar with the idea and the concept. How much ownership does Bill Gates have in his Microsoft company? Now, remember, he was the founder of Microsoft. He started it. So when he started it, he had 100% ownership. Bill Gates owned 100% of Microsoft. But he sold some of it so that he could raise some capital, right? Because he's a capitalist. So he raised some capital by selling some of his Microsoft stock, and he took the profits from that and he went and built a bigger company. So that took the ownership that he had and made his 100%. Maybe he owns 50%. That 50% became larger and more valuable than his 100%, right? That's how capitalism works. You sell off something in an effort to gain profits so that you can take those profits and grow them and make them bigger. Again, this ties back into ROCC. We're going to get to it in just a second. So as long as you understand these concepts, this is how you make money in the capital markets. And so the capital markets are growing over time, and he's taken his profits, selling off part of his business so that he can make his business bigger, so that his ownership is bigger than it was even at a larger ownership version. The smaller ownership is larger, so he's making more money. But nonetheless, at this point in time, how much money does Bill Gates have? Well, he's got a lot of money because he sold off a lot of his shares because he needed the money, right? So buy low, sell high. Well, that's what he did. Microsoft's growing really big over time, and he sold. He keeps selling off his shares So how much does Bill Gates own of Microsoft right now? 1%. Did you know Bill Gates only owns 1% of Microsoft? Now, 1% of Microsoft is still a large amount of money, but nonetheless, he used to own 100% because he wanted to take profits off of a capital market. He had to sell it to take his profits. So at some point, if you sell off all your capital that you bought low and you have to sell to take it and realize the gains and go spend it and buy things like food, right? Or clothes. Now, we're not Bill Gates and we're not going to have millions and billions of dollars like he did. And I'm not hurting for Bill Gates. Bill Gates is not hurting for money. He's got plenty, and 1% ownership of Microsoft is still a very large amount of money. But most of us are not going to be in that category, but the concept is the same. If we sell off all of our money or all of our shares, if we sell off all of our shares of our capital gains, we don't have any capital gains left and we run out of money. Now, if those of you who are approaching retirement and old age is going to take your job and you're worried about having enough money and not running out before you die, because that's really the end game, right? Dying is kind of the end game. At that point, you don't need any more money unless, you got a real, sticker in your bun that makes you want to give money to your kids. A lot of people want to do that. So you want to have some money left over to give to your kids when you die. But really, you don't need any more money after you die, right? You're done. You don't need any more. Man, maybe you got a wife and she's going to live longer than you. Well, you want to have enough money for her so that she can have some money to continue to live after you die. So you want to set that up too, right? So you don't want to outlive your money. That's the question. That's the problem, right? But if you keep selling it off, you end up like Bill Gates, and where you had 100% ownership of something that was very valuable. Now you only own 1% ownership of it. Yeah, it's still valuable, but you still only own 1%. If you start selling off his 1%, eventually you won't have any, and he won't have any income left, right? And he'll be out of money. Can you imagine Bill Gates running out of money? Again, we're not in that category of Bill Gates, but nonetheless, that's one of our big concerns, right? When we get older, running out of money. So we want to be able to have a capital system that still makes us money over the long haul and doesn't run out of money. So how do we do that? Well, we have to think about things in a logical way. And the way you think about them in a logical way is you say, well, there's multiple ways of doing things. Now, I want you to think about the stock market. The stock market is like a sandbox. What? It's like a sandbox. What are you talking about? It's like a sandbox. It's a financial sandbox. You can come into the financial markets. You can come into the world of finance, into the stock market, into the futures market, into, any of these, cryptocurrency markets, and you can create a model of different financial ways of structuring your portfolio, of structuring the money to do things that you might want it to do. And there's multiple ways to do that. Now, what we like to do is we generally like to look out into the real world, right? We look out into the real world and we're like, okay, real world, how do you make money in the real world? And then we like to take those examples and create them and model them in the sandbox, in the financial markets, in the stock market. Well, one way is to buy things at low prices and sell them at high prices. We do that all the time, right? We manufacture an iPhone for $10. Is apparently, my understanding is that's how much it costs Apple to make an iPhone over in China, because that's where they make them. $10 is what it costs them, 10 US dollars to make an iPhone. And then they sell them over here for $1,000. Okay. So we buy low and we sell high. That's how we do things, right? We make things, we create things, manufacture things. That's why it's important to manufacture, right? We manufacture, we make things, and then we sell things. So we have things, and things we buy for a lower price, we sell for a higher price, and we sell them and we make the difference between where we bought them and where we sold them. So we have to do a lot of that. Now, you're not going to live off of one iPhone. So you got to make more than one iPhone, and you got to sell it. You got to market it. You got to sell it. You got to do all that stuff to buy low and sell high. And so you buy something low and you sell it high. You buy a car from your brother and you sell it to your buddy for more than you bought it for. So you bought something that was manufactured at a lower price, you sell it at a higher price. Everybody understands that concept. So when you go into the financial markets, you go into the stock market, you understand that same concept, right? You're like, well, how you make money. And we're going to model that in the sandbox. In the sandbox, we're going to do things where we buy low and we sell high, because everybody understands that concept. It's kind of drilled into us from a child. We understand that that's how we make money: buy low, sell high. Most of us go to work. We trade our time for money. And what we're doing is we're trading our time for money for somebody who's trying to build something so they can buy it low and sell it high, whether it's a pencil or an iPhone. You are manufacturing something, you're making something, you're working on something, you're an architect. Maybe you're providing a service, you're drilling somebody's teeth, right? You're taking an old rotten tooth, you're making it a good tooth. You're taking something that's bad, making it good. So therefore it's a lower price, it's worth a higher price. Somebody gives you money for that. So this concept of buy low, sell high is proliferated throughout capitalism, throughout a capitalist society. And so we all buy low, sell high, right? You break your leg, even a doctor is a capitalist, right? You break your leg, you come in with a rotten leg, he fixes it all up, patches it up, and sends you out the door with a good leg. So you take him a bad leg and he gives you a good leg. You pay him for that. Something low worth something more valuable is the difference between the cost of that leg that's broken, right? So everything could be turned into that kind of a model. So how do we take that model and put it into the financial markets without actually having to fix broken legs, drill teeth, or buy products and sell products, which is what most of us do, right? Or manufacture products and sell products, and then go through the entire capitalist process of marketing, hiring people, and selling the products. That's a whole process called business, right? It's called going into business. You're going to make coffee, you're going to sell coffee, you're going to take coffee beans and turn them into coffee, and somebody's going to pay you more than you paid for the coffee beans. Your labor, your time, your effort, your energy of doing all that is going to make you money. So that's a capitalist society, but we don't want to be coffee makers. We don't want to be dentists. We don't want to be tooth drillers. We want to just reproduce in the sandbox that same concept, that same idea of being able to buy low, sell high. And so that's why the stock market was created in that sense. Now, when I say it's a sandbox, there's lots of different ways that you can make money in the markets. All right. Now, again, be careful. Stick with me. This is tying back into ROCC, and we're going to get there in just a second. But I'm using a paragraph or a sentence will do because I want to drive this idea and this concept home, because I want you to think about the markets in a different way. I'm going to shift your thinking. Okay. I'm going to take your brain that has been driven into and drilled into for your whole life thinking one way, and I'm going to make you switch and go bonk and go the other way. Okay. We're going to think a different way. So I want you to stop thinking like an employee of and start thinking like a manufacturer. I want you to start thinking like a businessman. Instead of an employee of a businessman or a businesswoman, I want you to start thinking like the businessman or businesswoman themselves. All right. So you have to put yourself on the other side. Now, many of you may already have some experience with that. Oh, Lan, I owned a used car lot. Okay, well, you already know what it was to be in business. There's a lot of people who have been in business. They understand how running a business is different than working for a business. Okay. So we can actually produce both models in the stock market. What's another model that we can put into the stock market? Another model that we can put in the stock market, another way to make money in the real world that we try to produce in the financial world, is the real estate industry. Now, you've oftentimes heard that real estate is one of the best ways to make money, right? Best ways to make money is in real estate. If those of you who have been here with me in the past, real estate. I have a lot of real estate. I own like 8 doors, right? Or something like that. If I went counting, let's see, 1, 2, 3, 4, 5, 6 or 7 doors, right? I think I sold a couple of them. So yeah, I've sold a couple off. So I don't have that many anymore. I try to get rid of my real estate. I don't like real estate. Why? Because you have to go fix broken toilets. You have to buy insurance. You have to have, slip and fall accident insurance. I had some, I think I told you guys, I have a big building where my business used to be. I sold my business and I had a building. I sold the business, but I kept the building. And so the building is now rented out to a number of companies, right? And not just the business I sold. They're still there too. But my lawn man, the guy that mows the lawn, He left the sprinklers on and it froze and put a sheet of ice on the sidewalk. Yeah, guess what happened? One of the people who rents the building, one of the employees of one of the guys who rents the building, came walking in there, stepped on that ice, whoop, bam, hit her head, filed all kinds of, well, she's threatened to file lawsuits. She hasn't a lot of suit against me yet, but she has gone after her employer, which is funny. You'd think she'd come after me first, but she went after her employer and he had to pay thousands of dollars. And so now he's coming to me and saying, hey, you need to share in this because it was your fault. I'm like, it wasn't my fault. It was the guy who mows the lawn's fault. And he's his own business. I'm going to sue him if you guys sue me. She's going to sue you. You're going to sue me. I'm going to sue him. And it ends up being a nasty thing. And that's what real estate is all about, right? Pass the buck, fix the toilet, fix the roof. Real estate is constantly in decline. So the building was new, 15 years ago, but now it's an old building, 15 years. Now we have to start fixing things up and it's costing us money and bricks are breaking and sidewalks are crumbling and the roof is broken. We got to put money into it. And it's costing me all kinds of money to keep pumping back in, keeping this damn thing running. That's real estate. People tell you, hey, real estate is a great thing. It's one of the best ways to make money. Why? Because you have a physical asset that is increasing in value. Now, is it really increasing in value? Well, possibly increasing in value. But what's really happening is the US dollar is being depressed in value, right? Because of inflation. So because of inflation, maybe 2, 3, 4, 5%, 6%, 7%. What's inflation been lately? Not very good, right? So you have inflation, which is the devaluation of the dollar. So it takes more dollars to buy things. Therefore, if you own something, well, it's going to take more dollars to buy something. So you bought it for $500,000 or 800 or $1 million. And now it's worth 2 million because over 15 years, the dollar has gone down a certain dollar amount, a certain value. Has the value of your asset really gone up or has the dollar value just gone down? And so now you need to spend more dollars to get the same asset, right? So you have to have what we call outperform. You have to have assets that will outperform or grow faster than the dollar can depreciate or faster than the depreciation of the fiat currency that we live on, right? Faster than depreciation. Okay, so that's what depreciation is. All right, and that's what inflation is. Inflation is the depreciation of the dollar, which causes the product or the item that you own or that you bought to go up in value. It's not really going up in value. Well, it probably is. It needs to go up in value, right? It needs to be more valuable. But if you got a piece of property and it's decaying over time and the roof is falling apart and the bricks are falling out and you got lawsuits coming in at you and the concrete needs to be replaced. Well, is it really going up in value or is it going down in value? But it seems to be more expensive only because the value of the dollar is going down. Okay. So you have to fight against that. And those are all mathematical models that we build into spreadsheets and we try to make calculations on whether we're actually making any money or not. So anyway, real estate is one of the best ways to make money. Oh yeah, let's go. I'll buy a bunch of real estate. And why is it a good way to make money? Well, because you have the asset, which grows in value, like we just talked about, but you can rent it out. You can rent it out. You can make people pay you to live in that asset, right? Or to put their businesses in that asset, depending on whether you have commercial real estate or whether you have homes and private real estate, right? Private. So anyway, nonetheless, you have an asset, a house that you're renting to a renter, and you get money coming in all the time. So now you have a different model. You can buy low, sell high, or you can reproduce a model which has an asset that returns money. So you can have the asset itself, right? That's what a stock is. So a stock, if you buy one share of stock, let's say 100 shares of Microsoft 20 years ago, 100 shares of Microsoft 20 years ago, and you just sat on it for 20 years. Well, it increased in value quite significantly, but how many shares do you still have? You still have 100 shares. It's all you have is 100 shares because you bought 100 shares 20 years ago, but now you have 100 shares that are of greater value. You bought low, but to get rid of it, like Bill Gates, you have to sell it. Well, if you could take that asset and have them pay rent on it all year long, right? That's a better way. This is called intrinsic value, is what we call it in the financial markets, right? So we'll get a little technical here. The product itself is called the intrinsic value, and it goes up and down in value every day. That's why we have markets to go up and down, up and down, up and down, right? Intrinsic value. And then you have extrinsic value. Extrinsic value is the value that the intrinsic value produces. If you don't have any extrinsic value, you only have intrinsic value. A stock itself only has intrinsic value. So if you buy low, Microsoft stock, you buy it, and then in 20 years you sell it, well, you'll still only have 100 shares. It's just that the intrinsic value increased. Now, in real estate, and the reason people say real estate is better than the financial markets is because you can get extrinsic value. Extrinsic value is the rent on the intrinsic value. So somebody rents your intrinsic value, and they give you extrinsic value. So I have this building, right? I have like four people, three renters in there. So I have three renters, three businesses in there, four businesses in there that are renting from me. And what they're doing is they're paying me extrinsic value on my intrinsic investment, which is the building, which is continually decaying and causing me all kinds of stress and worth, you know. So I've got the intrinsic and the extrinsic value. Now, if we come back to the stock market and we say, well, I would really like to be able to have intrinsic and extrinsic value and have that model, and I'm going to go into the sandbox and I'm going to create that model into the stock market. How do I do that? Because I don't really want to own physical assets. I don't want to deal with broken toilets. I don't want to deal with having to have products an intrinsic value that continually decays in value over time. All right. I want something that, you know, and maybe even in the stock market, it's going to still go down. You can still have, you know, you can buy into a stock and it can still go down. But if it's returning extrinsic value and it's returning the extrinsic value faster than the market is going down, hey, you're still making money. So anyway, that's the concept. And we're going to get into that because that's what ROCC is. We're going to take the financial markets, or we're going to take the financial sandbox, and we're going to recreate into it. We're going to create a business or a intrinsic, extrinsic value service that's going to pay us on our money. So now there's a number of ways that you can do this, and it's been done for almost, you know, ever since the stock market's been around. And not quite, because options were invented, you know, not when the stock market was initially invented. They came later. But options are a way of getting extrinsic value from your intrinsic value. All right. So you have the intrinsic value of the stock, the Microsoft stock. We bought $100 worth of stock, and over 20 years, we still only have $100 worth of stock. So it increased in value. Yes, the intrinsic value increased, but what if we could get some extrinsic value and reproduce in our sandbox the same concept or the same idea as what we were doing over in the real estate industry? We're going to rent out or receive income from our intrinsic value. Now, that's what we're doing here. If you come and look at all these green ones, these are all intrinsic value. Not really, but kind of. It's kind of the same concept. But what we're doing is we're collecting intrinsic value on the underlying asset. Okay. So if you own 100 shares of stock, you can actually sell options against it and collect the premium, which we call extrinsic value. Now, many of you have heard of that concept, right? You sell options. It's called covered calls or naked puts. But by collecting premium, it's kind of like taking your intrinsic value. And this is where we're going to take the sandbox of the capital markets, and we're going to reproduce something that's in the physical world. And we're going to say, all right, in the physical world, there's real estate, and that's a really good way to make money, but I don't want to really get into the world of real estate. It's a pain in the butt. So I'm going to reproduce that model in the financial markets in my sandbox. And the way you do that is you buy some shares, and then you sell covered calls or buy naked puts, right? Sell naked puts or sell covered calls. And so you're going to collect rent on your asset. Now, we're not going to go into that in great detail because I want to go to the next level. I want to take you to the next level, all right? A third sandbox, okay? I want to take you to a third sandbox because you're like, all right, Len, I'm going to gird up my loins and I'm going to figure out how to, one, buy shares in the stock market, which is not hard. You hit a button, right? It takes money to make money, so you do have to buy some shares. And then, Len, I'm going to learn how to do covered calls. All right, you're going to do covered calls. And I'm going to learn how to do that. Now, that sounds a little intimidating. I'm going to learn how to do covered calls, but you've convinced me I don't want to go out into the financial, or I don't want to go out into the world and do physical real estate because that's a real pain in the butt. You kind of talked me out of that. So I'm going to reproduce that world over here in this sandbox, and I'm going to just do it over here. Doesn't mean there's not risk. I mean, there's a lot of risk of going out and buying a bunch of a bunch of real estate and trying to rent it out. You can think of all the risks that comes along with that. Real estate's very expensive right now. If you don't have enough money to buy it outright, you don't have the cash to buy it, you're going to have to borrow it. Now, how do you reproduce that in the stock market? Well, that would be called putting your purchases on margin, right? You have to borrow the money to make the money so that you can make the extrinsic value. That would be putting your positions on margin. You can do that in the real world by going and getting a loan from the bank. They give you money, you buy the house, then you take the house and you rent it, and the money that comes in pays the bank and hopefully gives you a little bit of money to put in your pocket and maybe buy new roofs or keep the house up, right? So it doesn't deteriorate to a point where it's not of any value. So you have this money coming in, this extrinsic value. Well, we need to reproduce that over here in the stock market. So if your house goes down in value out in the real world, well, you still have your rent coming in and you don't fret, right? Because you got your rent coming in. Well, we can do the same thing over here in the stock market. If you buy a stock and it goes down, well, we're not going to fret too much because we got our rent coming in. We're selling covered calls. We're collecting premium, right? We're making money. And so we don't really worry too much about the stock going down because we're making money off the stock. We're going to hold on to it for the long haul anyway, right? Because we bought 100 shares and in 20 years we'll sell it and be rich, rich, rich beyond our wildest dreams. So that's the idea. But in the meantime, why don't we collect some extrinsic value? Why don't we rent that property out or rent those shares out to somebody else, and they'll pay us, and that's how we get extrinsic value. And you're like, wow, man, this options thing is really cool, but it's kind of complicated and kind of hard to do. Well, it can be, but it doesn't have to be. I mean, you can learn it. Most of the guys in this class are learning it. All right, you're here, and that's why you're here. You're learning the concepts. But what if you could hire somebody to do that for you? What if you could say, well, you know what? Why don't you're pretty good at trading options. You've been doing it for 30 years and you got a pretty good track record. Why don't you trade the options for me? All right. I tell you what, rather than me buying Tesla or rather than me buying Microsoft, I'm going to give you my money and you go buy Microsoft, you go buy Tesla, and you go trade the options on those markets for me. Does that sound like a good idea? Why don't you guys just all send me your money and I will trade your options for you? Does that sound like a good idea? I've been doing it for a long time. I know how to trade options. I'm, got a pretty good green portfolio here. If you just send me your money, I will trade options for you. Now, I'm not going to do it for free. I'm not just going to make you rich, rich, rich beyond your wildest dreams without taking a fee. You got to pay me to do it. I mean, if I'm going to sit here and trade your options for you, you got to pay me. So there's a fee to do that, right? So you have to pay me. And you're like, well, that's fine. Well, it's not a cheap fee. I might be easy, but I ain't cheap, right? So that money's got to come to me. You got to pay me a good little fee to get that done. And but I'm gonna, possibly return you some good money. There's a good chance we could make some good money. And so you're like, well, I think it's worth it. I'm going to give it a shot. You're probably better at trading options than I am, and so you probably make more money than I would anyway. And so I'm willing to pay you some money to do that. And so you're going to send me your money and I'm going to trade these options for you. And we're going to create, or we're going to model kind of that real estate business. I'm going to run your real estate business for you, but it's not really a real estate business. We're going to recreate that model in the capital markets, right? Because it's a sandbox and we can do whatever we want. Now, what have we just done? We've created another model, haven't we? So I'm going to be trading the real estate model for you because you're going to give me your money. But between you and me, what have we just done? We just created another model, a business model, right? You are now the venture capitalist. You are a venture capitalist. You have money and you want to make money off of it, but you don't want to actually do the work. So you want to give your money to a business. Now, first of all, you could give your money to Microsoft, which is what you're doing, right? You're giving your money to Microsoft, and that's how we do the first model, which is Microsoft will take your money, they will grow their business. You have 100 shares, and in 20 years, you'll still have 100 shares, but hopefully you'll have a bigger number on those 100 shares. Those 100 shares will have increased in value. You could do that yourself. You don't need me. But there's no rent. You're not going to collect rent on that. All you're going to do is you're going to get intrinsic value. But you're like, hey, I want some extrinsic value, Lan. I don't want to have to sell my shares to make money. I want to get that rent coming in every month because I need to live. I need to live off this. I want to put some money into into something else, and I got to buy some shoes for my kids. I got to buy some food for my family. I got to pay for the house payment that I live in. There's other things you want to do with the money, right? So you need to have that rent coming in. You can't just sit on your investment and wait 20 years and then sell it and then live off of that. That's the first model, right? So the second model is, well, we're going to get the rent coming in. So that's model number 2, which we're reproducing, which is very similar to what we're seeing out in the real markets. And then the third model is the model that you and I just created between us. I'm going to start the business, right? I have a business. What am I going to do? I'm going to trade your money for you, and you're going to pay me a little fee out of that. I get to keep some of the profits, all right? And I'm going to return to you the extrinsic value, and I'm going to trade for you your money as it goes up and down, right? I'm going to take your intrinsic value. You're going to give it to me as an investor. I'm going to take it, and now we have a basket of money. It's not Microsoft. It's not Tesla. It's not anything else, right? It's a basket of money that you gave to me. Does that make sense? You gave me money to trade those markets with. Now, if I take that money and I put it into those markets, and those markets go up and down, it's going to affect our basket of money, right? This basket of money is going to go up and down based relatively on the Microsoft stock itself. But I'm going to take it, I'm going to put some in Microsoft, I'm going to put some in Tesla, I'm going to put some in some other markets, and then I'm going to have markets going along that I can put money into. And generally, we're going to decide between you and me which markets those are going to be. Maybe what we're going to do is we're going to do the Magnificent Seven, right? We'll stick with Tesla, NVIDIA, Microsoft, Meta, some of these, Amazon, Apple. We're going to stick with these really big, really good markets so that you're like, well, I feel comfortable putting money into those markets. They're good markets. They're not going to go out of business. And I'll give you my money, but as long as you kind of stick it in those markets that I agree to. You're like, all right, that sounds like a deal with me. I'm going to take your money. We have a basket of money over here, and I'm going to put it in these other markets. Now, if I put it in these other markets, our basket of money is going to go up and down based on what those other markets are doing, right? Now, if we just put it in one, let's say we have a basket of money and you approve me to put it into Tesla. You said, just go trade Tesla. That's all I want you to trade with my money. Okay, I'm just going to trade Tesla. So we're going to go in and we're going to put your money. I'm going to take your money. I'm going to put it into Tesla. That means that it's going to go up and down like Tesla does. But that's not our concern, right? Because you wanted me to trade options on it like a real estate. So I'm going to go and trade options on it. And as I make money trading options, I'm going to take the profits from my options that I'm making. I'm going to put it back into our basket. And the basket's going to go up and down in value because we put the money into Tesla to do that with. So we take your basket. Now remember, this is your basket. It's not in the markets. It's a basket of money. So we have this basket of money. I can put it into Tesla because that's all you approved me to put it into. So now I'm only going to trade Tesla because you trust Tesla. You believe Tesla is a good company and it's not going to go out of business. So I'm going to put our money into your money into Tesla, and I'm going to trade options on it. And if Tesla goes up in value, well, that's okay, right? We make some money on the intrinsic value. But we're more interested in the extrinsic value because I'm going to trade options and collect this premium out of here. So now we're going to grab some of these greens over here and we're going to put it back into our basket. And our basket increases in value. That's pretty cool, right? That's what we want. We want our basket to increase in value. But now what are we going to do? Well, I need to go pay my house payment. So what are we going to do? Well, I'm going to take every month, I'm going to take a agreed amount of money, and I'm going to take it out of this basket, and I'm going to give it back to you. Does that sound cool? It's what you want, right? I mean, you wanted me to make some rent for you, some extrinsic value, and we're going to give that to you. Well, if we do that, what's going to happen to the basket? The basket's going to go down in value. Why is it going to go down in value? Because I gave you some money. Does that mean that Tesla or Tesla went down in value? No. The basket went down in value. The basket went down in value because I gave you some. Does that mean you lost money because the value of our basket went down? No, it doesn't mean you lost money. It means I gave you some money. So this is where ROCC comes into play. That's why we call it return of cash and capital. So you give me money. You're like, Lan, I want you to trade my money for me. Okay, send me it in. I'm going to put it into this basket. And now we have a basket of money. You're going to send me money. I'm going to put it into this market. I'm going to then put it into Tesla. I'm going to make money doing options, and I'm going to take that options premium because you're not as good at trading options as I am, right? You agree to that? And besides, you don't want to waste your time all day. You want to go do something else. You want to go play golf. Maybe you want to go on vacation. You want to go on trips. You want to go whatever it is you like to do. Hike in the mountains, fish, right? Hunting, go pheasant hunting, whatever you want to do. You can go do what you want because I'm working for you now because you're going to pay me. I'm going to get a fee for doing this. I ain't doing it for free, but I'm going to make money, probably more than you could have made anyway, because I'm a better options trader than you are. And so I'm going to take that options premium, I'm going to put it back in this basket, and every month I'm going to take some out of this basket and give it to you. So this is going to go up and down in value over time. And you're like, oh, don't freak out. I don't care. It's money that Land's using to trade Tesla, because I only told him he could trade Tesla. So I'm not trading anything else with it. I'm just trading Tesla. So I'm trading Tesla. And as I make money, it goes in here. As I lose money, it comes out of here. So this is going to go up and down in value, but it doesn't matter because I'm making money trading options. I put the premium in there, and every month I'm going to take some money out and give it to you. And every time I take money out, this value goes down. But does that mean you lost money? No, it just means I took some money out of here and gave it to you. Distribution, a distribution of the money we made. Now, sometimes I don't make as much money. All right. Sometimes I don't make as much money one month. Maybe it's a little lower than what I promised to give you. So what do? I return some cash because I told you I'd send you, let's say, $1,000 every month or $2,000 every month based on the amount of money you gave me to trade with. So we have this agreement of how much money I'm going to send you. Well, I only made $750 this month. So what do? I told you I was going to send you $1,000. I send you some of the capital or some of the cash that you gave me. I just give you $1,000. But only 700 of that was from options profit. 200 of it was from the cash that you gave me. So I give you $1,000 back. So what am I doing? I'm really just giving you your own money back. Do you care? No, you don't really care. I gave you $1,000 back. And eventually the idea is that this will grow back again. I'll trade some more and we'll put that back in. Now, what if I make too much money? I told you I was going to make $1,000. I told you I was going to make $1,000 or give you $1,000 every month. That was our agreed on. My goal was to try and give you $1,000. Now, sometimes I'll give you a little more. Sometimes I'll give you a little less, but within reason, I'm going to try and give you $1,000 every month. So I'm going to take that $1,000. I'm going to give it to you. But what if I made more than $1,000? I can give you a bonus. I can say, okay, I'm going to give you not only $1,000, I'm going to give you a little bonus. Here's your $1,000, and I'm going to give you a little bonus. And now you get $1,200 instead. You're not going to complain about that, right? But what does that do to our pool of money? It drops it, makes it go down. All right. Our pool of money is going to go up and down based on how much I give you, how much I make. And that's what this is. But this is not Tesla. This is not Tesla. This is our pool of money that we operate. This is our operating capital, if you know what business terms are, right? Business terms, operating capital. So the operating capital can increase and decrease in value. Now, what if you want to give me more money? Because right now I've agreed to give you $1,000 based on the operating capital you've given me to operate off of. You're like, well, I want to give Land. He's doing good. Man, he's making money for me every month. I get $1,000 check. I want more money. And where are you going to get more money from to give me? Well, you can get it from two places. One, you can go out and you can work. Go back to work. Stop fishing. Stop hunting pheasants. Go get a job. All right? Get a job? I don't want a job. Who wants to work? Right? I don't want a job. I want to give you money without having a job. Okay, well, how's another way you can give me money if you don't want a job? I lost my job. Old age took it away. Well, you can give me some of the money I'm giving you because you're earning money from me, right? So you can take this money that I give you as a distribution out of our pot of money, and you can just give it right back to me. Okay, that's called reinvesting, right? Reinvesting your money back into the same pot of money. So I give it to you, you turn around and give it right back. And I put it back in here. Now, next month, I give you $2,000 because you gave me more operating capital. So now I can operate more. I can make more money. I got more money to operate off of. I can give you some more next month. Oh, you just give it right back again. That's pretty cool. I give it to you. You give it right back again. Now I got more, and I'm going to give you more every time. Now you can say, oh, now I'm going to go. I want to go on a hunting trip and go hunt pheasants with Land. Okay, well, you're going to only give me back half of what you gave me. You're going to keep half of it so you can go hunting, and then you're going to give me half back. That's cool. You're growing this little nest egg, this little business of yours, this capital. Okay. So this capital is going to go up and down. Now, what we've done is we've created 3 models today in the stock market. We've created model 1, which is buy low, sell high. We all understand that when we're manufacturing iPhones for $10, we're selling them for $1,000. That's one model. We've reproduced that. Buy low, sell high in the stock market. Way to go. Good for you. That's the most common, most popular model. The second model is we've recreated in our sandbox the real estate model. Okay. The real estate model is the model where you own something and you rent it out and you get premium from it, right? Extrinsic value. We've recreated that. We buy our Microsoft stock and we sell options on it and we collect premium and we make money that way. All right. It's rent on our property. So now we've recreated that in our sandbox. The third model that we've created today is a business model where you're going to hire me to do work for you and I'm going to trade for you and I'm going to return to you the capital that I earn. And we've got a third model out here. We've got this model that is this pool of money. Now you're like thinking in your head, you're like, well, where's that pool of the money in the stock market? Land's got that pool of money. Where's he putting that money that I gave him? Is that money over in his own personal bank account? Is that money in his pocket? Well, Land's probably got to have some sort of a trading account so that he can trade it for me. So he's probably got an account with Track and Trade over at, Track and Trade. So he's got his money in the Track and Trade account, and then he's trading over there, and then he's going to pull money out of his Track and Trade account and give it to me. That's probably what he's doing. Where's Land putting that money? Well, I want to be able to see how much that money's going up and down. Why? Why do you care? Why do you care if this market's going up and down, this money, when I'm investing it here and giving you cash? Why do you really care what my business is doing over here with your money? Well, because it's my money and I want to track it. But what difference does it make if it goes up and down in value a little bit? Do you really care what this basket of money does? The only thing you want is you don't want this basket of money to go really high. Why not? Why don't you want this basket of money to increase in value? Because if you want to give me money back, you have to buy into this basket of money. And if the basket of money gets really expensive, you have to pay more money for it. And you're getting less of what it is that you're giving me the money for. So it's not working as strongly for you. You'd like this number, this value to stay the same, because every time you give me money, you have to buy into it and you want it to stay low. So you don't really want this value to go up. You want that value to go up. You want what I am investing in to go up so that you can put the money, so I can take the money out and put it back in this one. But every time I take money out and put it into this one, it drives this price up. And if you want to put more in, you have to pay the higher price of my basket. So I take money out of my basket, put it to you, and when I take money out, it drives the price down. And that's good for you. So if I keep taking cash and capital that you gave me, cash I earn, and I give it back to you, it drives the price of this basket down because there's less money in there, so the basket is lower. That way, if you give me money back, you can buy more of this basket at a lower price. And that's a good thing for you because then I can use more money, cost you less to get it, and I can use more money to make money and put it back in here and build the capital and the cash back up. Right? Build the cash back up, not the capital, because you're going to keep giving me capital every month because you want to grow your shares. So you don't want this to go really high. You don't want me to have really expensive, charge you a lot of money to put your capital in here, right? To put your cash in there. And it's my capital because it's my business. So where is this money? Where is this money in the stock market? How do we track this money? Well, there's a company that does this. Now, it's not going to be LAN. I'm not going to actually be the one doing it. There's a company called YieldMax that has started doing this about 2 years ago. And they've started building this business model in the stock market. Now, it's relatively new. 2 years in the stock market, that's brand new. That's like wah, 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 right? Baby stuff. This thing is still an infant. But we do have some history on it. And the reason we have history on it is because it's an options history. And options have been traded for hundreds of years, right? No big deal. We know what an option is. All we've done is we've created this third model in the stock market now called the business model or the venture capitalist model. Again, it's a sandbox. We can do whatever we want in these markets. We can create these different models that we see out in the real world. We do it in here in the sandbox environment. And what we've done, or what YieldMax has done, is they have created for us another model, a third model, a business model, a venture capital model, where you give them your money and they will trade it for you against these other markets. Now, you don't want this basket of money to increase in a whole bunch. That's not the goal, because if it does, it makes it hard for you to buy more. So they're going to take the capital and they're going to take the growth. They're going to take the capital that you give them and the growth, and they're going to give it back to you as income, like rent. Okay. And so you can come in, and if you wanted to just get the growth itself, you would just go to the Microsoft stock, or you just go to Tesla itself and put your money in Tesla. You'd get growth. This bucket of money is not going to grow. You don't want it to grow. Makes it more expensive for you to get more shares of this bucket. And you don't want these shares to get expensive. You don't want your house. You don't want the property that you're going to be renting that's going to collect rent to get more expensive. It makes it hard to make the money off the rent, cover the cost of takes it longer to pay back the money. So you want this to stay low. You want this bucket to stay low. So if we go in and we look at some YieldMax funds, all right, YieldMax is the land turner. You're giving land turner the money to trade your options. You're not going to actually give it to me. You're going to give it to YieldMax. That's what those guys do. They're really good at trading options. All right. So they're going to come in and we're going to pull up Tesla. They have one called TSLY. All right. So if you want to see TSLY, this is TSLY. So if you want to give YieldMax your money to trade for you, right? This is their basket of money. It's called TSLY. You would buy into TSLY. And they're going to give you what they call a dividend. It's not really a dividend, because a dividend is something different. A dividend is shares of a company that they're going to share their profits with you. They usually do that on a quarterly basis. But in here, they're going to do it for you every month, or some of them they even do every week. But let's say every month they're going to pay you out like rent on that basket of money. Now, that basket of money is not Tesla. It's a basket of money of capital that they have raised, which you're part of, you gave them, and they're going to then trade options on Tesla. Now, to trade the covered calls on Tesla, they have to buy some Tesla with that money too. So if Tesla goes up in value, this will go up in value. If Tesla goes down in value, this will go down in value, because it's going to move a little bit like Tesla. All right, because it is being invested in Tesla, but it's not Tesla. If you wanted capital gains and that's what you were looking for, buy low, sell high, you should just buy Tesla itself. Don't buy TSLY, because they're not going to invest in Tesla for the growth of Tesla. They're going to be selling covered calls against Tesla for the rent. So if you want rent on Tesla, you buy TSLY. If you just want to buy the house itself and don't want to rent it, go buy Tesla, TSLA. Okay. I hope that makes that clear. We have gone into a business arrangement. We have created 3 models in the stock market: buy low, sell high. If you just want that, go buy Tesla. Okay. If you want the house to increase in value and you want to make money on the increase of the value of the house, and you want to buy it low and you want to sell it high, just go buy Tesla. If you want to make rent on Tesla, you can do that yourself. You don't need Tesla, right? You don't need YieldMax. You can go and buy Tesla. You're going to get the increase in value just like you would if you bought low, sell high, but then you're going to start selling options and you're going to start collecting the premium yourself. You're going to do it yourself because you're a good options trader. You're going to do it yourself. Great. Cut out the middleman. Just go do it yourself, right? You want to go into business for yourself? Go get your rental property and start renting it. That's what that would be like. I'm not good at options, Lan. Okay, well, pay somebody else to trade you some options for you. Okay, well, that's where YieldMax comes in. So you give them your money. They put it into a fund that you can track and watch. It's called TSLY. It is not Tesla. It is the money that they're going to use to trade options on Tesla. Now it's going to be invested in Tesla, but it's also not going to be invested in Tesla. It's going to be invested in other things as well. They also put it in some bonds because they have to put this money in there, whatever the liquidity of Tesla is for options. You give them that money, and so their TSLY is going to go up and down in value, but you don't really want it to keep going high like Tesla. And now it's going to move up like Tesla, it's going to move down like Tesla, but they're going to do ROCC, return of cash and capital, out of that TSLY. ROCC is return of cash and capital. Every month, they're going to pay you back some of that money. They're going to take the cash that they've earned from selling options and they're put it into the basket. At the end of the month, they're going to take it out of the basket. Therefore, the basket will fall in value. Every time they pay out, every month, the payday, that value is going to plunge, okay? Because they took it out. Did the value of the stock go down? No, it didn't really go down. They're just distributing it back to you. They're just giving you the money, the profits they made, and your cash sometimes. Sometimes they'll give you your own cash back, depending on how much money they made. Sometimes they'll give you a bonus. All right. So you'll get a bonus, and you'll see that in your, when you look up your dividends. Sometimes there'll be two numbers. It'll say special, say dividend, and then it'll say special. Well, the special is the bonus. They made more money than they promised, and so they give you a special bonus. So you add those two together, and that's how much money they're going to pay you. All right. So you take special and you take dividends, you add those two together, and that's how much they're going to pay you that month. And it's more money than what they promised to pay you. That's why it's a special bonus. And then that's going to cause this fund to drop. Okay. That's why whenever you get a dividend payment, the fund drops, because they're taking money out and they're giving it to you. You're not really losing money because they're giving it to you. So you now have it. It's just not in this basket. It's now in your hand. Now you can go spend it, or you can put it back in the basket. Most people just put it right back in the basket and it goes back up. And that's where we get into another concept called linear growth or compounded growth, right? So linear growth is where you buy something for $100 or 100 shares, and in 20 years, you still have 100 shares. It's more valuable, but it's still only 100 shares. You didn't compound, you linear grew. Compounded growth means you bought 100 shares, you take the profits, which is what we're doing here, profits, and you buy more shares. Now you don't have 100 shares, you now have 110 shares. And then those 110 shares grow, and you take the profits, the rent, and you buy more shares. Now you have 120 shares. Now you have 130 shares. Now you have 140 shares. Now you have 150 shares. And so when you get to 20 years down the road and you're ready to retire, you got thousands and thousands of shares that have increased in value hugely and given you all this money, and you're wealthy, wealthy, wealthy beyond your wildest dreams, right? That's called compounded interest or compounded growth. So if you're just doing linear growth, buy low, sell high, and you buy 100 shares and sell 100 shares, that's linear. It's not compounded. Compounding is when you take the profits, which you have to generate as an extrinsic value, not an intrinsic value, an extrinsic value, and you pump it back into the stock. Now you have more shares because you are compounding with the extrinsic value of your intrinsic value. You're building more intrinsic value. All right. I went 10 minutes over our hour-long class, but I think we kind of said a paragraph where Sandals will do. Hopefully I drove it home. You guys got it, that concept, and you understand it. You need to have money to make money. You need to have money to make money. So if you want to give Tesla your money to trade for you, right, you don't really expect, you don't want, notice that the Tesla fund is $14 a share. Now, remember, when you get dividends, they pay you out based on the number of shares you own, not on the value you paid for the shares. Therefore, you want as many shares as you can get at the lowest price you can possibly get. Right? So you really don't want the TSLY fund to increase in value like the TSLA fund. If you want the TSLA fund, if you want to buy, if you're looking for it to increase in value, just buy TSLA. Don't buy TSLY, because we those of us who are in TSLY, we don't want it to go up in value. Why? Because we want to compound. We want to keep buying more TSLY so that we get more rent and more rent and more rent. And our rent grows, because with the more shares we have at a lower price, the better it is for us. We want it to stay down. We want it to distribute that money out, get rid of it. Don't hold on to it and have the fund go huge. We don't want this fund to get really big. Distribute that money out, get rid of it so the fund can stay low, so that when we buy back into it, our share price is lower. Because we get paid our rent based on the number of shares we have, not by the dollar amount that we paid for the shares. So the name of the game when you're trading this way, this is a third model. And don't get the two confused. Don't put your money into TSLY and then get mad because it didn't go up like TSLA did. Or, oh, it's going down, I'm losing money. You're not losing money. The value of the fund is going up and down. It's going down. So that gives you the opportunity to buy more shares at a lower price. So they distribute cash, which is the profit they make from the options, but they also distribute capital, which is the money you gave them. They give you your money back, your own money. You gave it to them to, well, we made too much money. We're going to give you some of your money back, and we're just going to operate off of the profits. That's good for you. You're getting your money back, and you're still making money. Eventually, it's going to get to what I like to call a cash cow, right? You get your cash cow, and you get on the gravy train. Once they paid you back all the money you gave them to go trade with, it's just pure gravy, pure profit. You want these guys to distribute cash back and capital back, ROCC, cash and capital. The reason they return the capital is to keep the price of the share price down so you can buy more at a lower price. If they kept your capital and the cash, that price would just keep going up. And then you'd just be reproducing Tesla. And what's the point? You missed the point. Tesla, just go buy Tesla if that's what you want. That's not what you want if you're buying it at TSLY. You want them to distribute back to you some of the cash and some of the capital so that the price just stays in this little channel in here. You just want it to kind of stay in the channel. And when it falls, when it comes down low, heck, that's when you want to pump some money in there, buy some more. It's nice to see the capital rise, yeah, but that's not really the point. The point is, this is not Tesla. This is their little fund that invests in Tesla. And it's the money they're going to give you every month as income. Now, you can do whatever you want with that money. You can reinvest it. You can reinvest it back into TSLY. You can go buy Tesla, TSLA with it. You can go buy Apple with it. You can go buy food with it. You can go buy a car with it. You can go buy a house with it. You can go buy anything you want with that money, or you can reinvest it. It's income for you. So you don't have to go work at the gas station to make money. Now, if you want to make money so that you can put money into TSLY so that they'll trade it for you, well, the way I like to make money is by trading in the stock market. So I'll go to the stock market. I have my own stock market account, and I trade and I make money. And when I make money over there, I give it to these guys now over here in TSLY. And they'll trade it for me and give me money. And then I take that money and I can do whatever I want with it. I can go invest it myself, try and make more money, or I can give it back to them, let them trade it. Right? Eventually, I can get to the point where I've given them enough money, I don't have to work at all. And you just have to decide how much that money that is. All right? How much money do you need? You can back into the math. And that's what this spreadsheet here is, right? That's what this spreadsheet is right here. This is the make us money so that we can give it to TSLY so that they can go into the business model, right, that we've recreated synthetically in the stock market. And I can find out and I can track the amount of money they're giving me back. And that's what I've done with this spreadsheet right here. And we'll go into this spreadsheet on Friday. Today is Wednesday. Tomorrow we're going to do day trading so we can make some money so that we can give it to Tesla, right? Or give it to YMAX so they can trade something for us. And then on Friday, we'll come back and we'll dive deeper into the spreadsheet once again. We've kind of talked a little bit about the spreadsheet. If you want this spreadsheet, this UBI spreadsheet, then you can get it. The way you get it is you subscribe to Pit News Magazine, and that's how you get it. There you go. Bruce has got this under his belt. He's been doing this for a little while. He is one of the first guys that jumped into it with me. And he says, what's great about compounding is that it's having a rental property where the rent income increases every month. Yeah, if you keep putting your money back into the fund, it's like getting a larger rent because you're buying an increase in a bigger and bigger house, right? You're getting a more intrinsic value. And so your intrinsic value, the number of shares you own, increases every month, every time you reinvest. Therefore, your rent increases too. And that's compounding, right? That's the compounding growth. So great comment, Bruce. And I'm getting ready to start a class at the university. If those of you who are local and able to go, my class starts on Monday, where we'll dive deep into this stuff at the university, and the classes are on Monday. So if you want to get into that class and you want to go into this in greater detail, we'll teach you how to do it at the university. You can come and meet us in person, meet me in person, and we'll learn about this stuff on Monday, the 27th. Monday night, 6:00 p.m. at the university, Utah Tech University, and you have to register with the university. Just go to ce.utahtech.edu. CE, so continuing education. ce.utahtech.edu, and you can come and join the class. All right, so you register with the university. All right, that is my lesson for today. Return on capital, ROC, and that should be ROC. We're going to put the extra C in there. ROCC, return on cash and capital, because they return both. So they can keep that price down. They don't want that price to go up. If you just want to go off the price, go buy a TSLA. That's what that's for. TSLY is if you want rent. Okay. All right, guys, that's it. That's the portfolio. You get this portfolio. You can get this spreadsheet, all these spreadsheets that I've created here. This is the trading spreadsheet. This is the ROCC spreadsheet. This is the cash cow model. This is one you can take yourself. This is the one we're using for our class here. This is one we're filling out and putting all of our information in. In fact, on Friday, we'll have some more money. We'll have received some rent, so we're going to have to put that into our model. So come back on Friday, and we'll actually receive a dividend, and we'll put it into our model, and you can see how that works. And then this is one that's just a model that you can take yourself and take out the information and put it in yourself. So this is one for you. And then the legacy UBI, this is the old one. This is one we used to use in the old-fashioned one. All right. And then this is just a calculator. So you can come in and it's like a little sandbox. You can say, well, if I needed to have this much money for retirement, how much money would I have to give to TSL? How much money would I have to give to WiMAX to return this much rent to me? And then this is just some of the funds that they offer. All right. This is a list of some of the funds they offer. And there's more of this, and they're adding them every now and again, but these are the funds. If you can either just go to Microsoft, like Bill Gates, or you can go into MSFO, which is get the rent. Let those guys trade options for you. So we built 3 models today in the financial markets because it's a sandbox, right? So the last one, the hardest one to understand, most people screw it up, is the whole idea that you want to be able to start a business, a rental business, but it's not a business. They're going to rent. You're going to start a business. You're an investment capitalist in their business of selling options. You're giving them money to trade with, and they're going to return your capital. They're going to return your cash. So it's a business model. Okay. Venture capitalist into a business model that's going to trade the stock market for you. Not Land Turner. I'm not going to do it. YieldMax is the company that does this. Okay. All right, guys, that's it. That's all I got for you. I do have a Sunday school lesson for you. When you're trading, don't swing for the fences. This causes horrible losses, turns winners into losers, causes inconsistent results. This is a marathon, not a sprint. All right, winners have a lot of base hits. All right, have realistic expectations. And so don't get out there and think you're going to make all your money in one day. It's a process. It's going to take time. It's going to take a little while, but we need to build up our process, build up our money, build up our capital, build up our cash, and then let that rent just roll in every month for us. All right. And it doesn't take nearly as much money to retire doing it this way as you might have thought at first. Okay. We can get you guys set up and retired relatively quick if you're going to work with this model. You just need to understand it and not get the 3 models confused of what's happening. Which model are you going to pick? And I'm writing an article for Pitt News Magazine about this. All right. I'm writing an article for Pitt News Magazine all about how this works. And so if you don't have Pitt News Magazine, that's how you get this. That's how you get this spreadsheet too, is you have to be a subscriber to Pitt News Magazine. I used to give it away for free, but then people started stealing it and using it on their own YouTube channels. So now you have to be a subscriber to Pitt News Magazine. And it's only $20 a month. Go over to pittnews.com, subscribe. You'll get this spreadsheet. And remember, in Excel, you get one file. You download it. It's a zip file. You pull that file out, put it on your desktop. You open it up in Excel. And all of these spreadsheets are in that one file. All right. There's tabs at the bottom. And that's how you get to these different spreadsheets. They're not different files. They're one file with tabs inside of the spreadsheet that gives you all these different spreadsheets. Okay. So it's all in one file. And that's how it works. I've had a couple of guys call me and say, hey, I only have one spreadsheet. I have this one. Where's the other files? No, there are tabs at the bottom. Okay. get you into the other spreadsheet. It's just one file. It's one Excel file. All right, and that comes with your subscription to Pitt News Magazine. It's regularly $39.95 a year for 12 issues. But if you subscribe to the magazine, it's only $19.95 right now. There's a coupon, and what's the coupon? Here, I'll just let Claire tell you about it, because Claire can tell you about it for those of you who haven't seen it. So for those of you who would like to get this spreadsheet and would like to get a copy of Pitt News Magazine, you can stick around. I'll let Claire tell you how to get that. The rest of you guys, thanks for coming. And if you liked it, go ahead and click that little thumbs up. I know it was a lecture and we didn't do much looking at the markets and a lot of drawing trend lines and stuff, but I was trying to get a concept off to you guys so you could understand what the stock market is as a overall sandbox that you can recreate different business models in, and you have to pick the one you want to use, which one you feel most comfortable with. Maybe you want to do all three. That's okay too. But which model you want to, just remember, don't get the two confused. We don't want this one to invest in this one and think that it's this one. You got to separate. Don't mix your peanut butter with your chocolate. All right. So if you like this, give me a thumbs up, and we will come back on Friday and we'll do this. And if you want to join me tomorrow at 2 o'clock in the afternoon my time, at 1 o'clock in the afternoon my time, that's Mountain Time, for day trading in the futures market, we're going to do that tomorrow afternoon. So come and join me for that, and subscribe, and I'll send you a little notification. Make sure you hit the little bell so it notifies you. And I'm going to let Claire take us out. All right. Claire's going to tell us how to get this spreadsheet, and it's by subscribing to Pitt News Magazine for half off right now.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pitt News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pitt News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pitt News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited-time offer. Head to pittnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.